Welcome back to The Explainer. I am super thrilled to have you here today. Look, if you're a startup founder, you already know that raising capital is exhilarating, right? But it also comes with enough dense legal paperwork to literally cure insomnia. Today, we're going to unpack one of the absolute most critical, yet honestly most misunderstood parts of all that paperwork. We're setting the stage right now to uncover the exact mechanics behind anti-dilution clauses. We're going to look at how they function, why investors absolutely insist on them, and most importantly, how you, the founder, can shield your hard-earned equity. Let's get right into it.
Okay, let's dive into this. Here is our roadmap for today's explainer. The down round threat, Ratchet versus weighted average, the hidden equity drain, navigating Indian startup laws, and we'll wrap up with negotiating your founder shield.
All right, kicking things off with Section 1, the down round threat.
I want to pose this really urgent question directly to you. What actually happens to your equity when valuations drop? You know, when you're building a company, valuations can shoot up or drop sharply in just a year or two. If your startup has to issue new shares at a lower price than your previous funding round, you're experiencing what the industry calls a down round. So for instance, say you raised your Series A at 1,000 rupees a share, but suddenly you have to raise your Series B at just 500 rupees a share. That earlier investor stake, it just lost a ton of paper value. And that is the exact moment the threat to your own equity becomes very, very real.
So what is an anti-dilution clause? Well, it's a contractual provision in your shareholders' agreement. It protects investors from losing value during that down round by adjusting their preferred share conversion prices. Now, I know that sounds highly technical, but here's the plain language translation. It's basically a safety net for investors. It allows them to get more shares when they convert, just to make up for that drop in value. But, and here is the kicker, those extra shares don't just magically appear out of thin air, and they definitely aren't bought with the company's cash. Nope, those extra shares usually come directly from the founder's pool. It protects the investors, sure, but it indirectly dilutes you.
Moving right along to Section 2, Ratchet versus weighted average. Now, what's really interesting about this is the stark contrast between these two approaches. First up, the full ratchet. Honestly, this is the most aggressive, punishing form of investor protection out there. If your share price drops from 1,000 to 500, the full ratchet completely resets the earlier investor's conversion price straight down to 500, regardless of how many new shares you actually issued. The investor's shareholding can basically double, and you absorb almost all the dilution. It's brutal. On the flip side, we have the weighted average. This is a much fairer approach. Instead of a harsh reset, it uses a formula that balances both the new, lower price and the actual volume of shares being issued. It spreads the impact out, protecting the investor without totally wiping out your equity in a single stroke.
But we kind of need to look even closer here, because the weighted average actually splits into two separate paths, broad-based and narrow-based. Broad-based considers your company's fully diluted share count, meaning all outstanding shares, options, convertibles, the whole shebang. Because the mathematical denominator is larger, the resulting price adjustment is smaller. I want to explicitly warn you here. The broad-based method is the global standard you should absolutely aim for. It's way more founder-friendly. Narrow-based, on the other hand, only counts a smaller set of shares, usually just the preferred stock, and a smaller denominator means a larger price adjustment, which just means higher dilution for you.
Which brings us to Section 3, the hidden equity drain.
Just take a second to look at this number. From 40% down to less than 30%. This is literally what can happen if you don't model these scenarios out before signing the dotted line. A founder holding a solid 40% stake could see their ownership plummet well below 30% in just a single down round if they're trapped under an aggressive full ratchet. A single provision, buried deep on page 40 of a legal agreement, can slice your ownership by double digits overnight.
And you know, it's not just your slice of the pie that's shrinking. We are talking about your entire cap table. When your equity drops, your voting power and your control at the board level drop right along with it. But it also hits your team. When new shares are printed to satisfy an investor's anti-dilution adjustment, the employee ESOP pool gets eroded. Employee morale can absolutely tank when they realize their options are suddenly worth way less. Plus, as you go on to raise a Series B or C, these protections stack on top of each other. Multiple investor classes with layered protections can create this tangled mess that completely wrecks your payouts during an exit or an IPO.
All right, let's pivot to Section 4, navigating Indian startup laws.
And this brilliantly illustrates just how complex things get for Indian founders, who operate in a highly specific regulatory web. The Companies Act governs the strict approvals you need for any new share allotment. But then consider FEMA, the Foreign Exchange Management Act.
If you have foreign investors, FEMA mandates that shares are issued at a fair market valuation, and that has to be certified by a CA or a merchant banker. So, an automatic anti-dilution trigger from a standard term sheet can face severe friction against strict FEMA pricing rules during a down round. Add SEBI's restrictions into the mix, and you can see why standard Silicon Valley templates just won't cut it here.
To put a finer point on it, actually this is crucial to understand. Indian company law outright prohibits issuing shares at a discount. Because a pure full Ratchet theoretically issues shares at no additional cost, it literally cannot be implemented exactly as written in many foreign term sheets. Because of this, those aggressive foreign templates have to be legally restructured. You end up having to jump through hoops, doing things like issuing bonus shares or adjusting the conversion ratios on CCPS just to remain compliant with the law while trying to hit the same economic outcome.
So how do we fix this? Section 5. Negotiating your founder shield.
Here is your action plan. 4 crucial steps to build that shield. Step 1, always push for the broad-based weighted average. Like we said, it's the fairest standard. Step 2, negotiate clear carve-outs, which we'll look at in just a second. Step 3 is honestly a game changer. Add pay-to-play provisions. This forces investors to actually put fresh capital into future down rounds if they want to keep their anti-dilution protection. If they sit on the sidelines, they lose the safety net. And step 4, model your cap table down round scenarios. Doing the math on a 20, 30, or 50% down round before you sign is absolutely non-negotiable.
So the crucial point here is making sure you have essential carve-outs clearly listed in your agreement. You have to ensure that routine business actions, like expanding your ESOP pool to hire a great new executive, converting your existing notes or safes, or issuing shares for a strategic partnership, do not accidentally trigger these massive anti-dilution penalties. Vague drafting here is super dangerous. Without these specific exclusions clearly defined, you might find yourself giving away equity just for running your day-to-day operations.
I want to leave you with this final provocative thought. Do you know what's actually hiding in your term sheet right now? Remember, the anti-dilution clause you accept at your seed or Series A sets the precedent for every single round that follows. It just sits there, quietly, waiting for a market downturn. I challenge you to pull up your current agreements today, review them holistically, and run the numbers. Don't wait for a down round to find out how much of your own company you actually own. Thank you so much for joining me for this explainer, and keep building.